The United States currently carries a public debt level that exceeds 120% of its annual economic output. China, through a combination of direct holdings, custodial accounts, and indirect exposure via offshore institutions, remains structurally linked to a significant share of global dollar liquidity. These two facts coexist without contradiction in public reporting. What has changed is not their visibility, but the scale at which their interaction has become systemically relevant. This analysis reconstructs the mechanics of that interaction without assuming intent, strategy, or outcome. In early 2025, Chinese financial authorities disclosed a coordinated balance sheet adjustment involving state banks, policy institutions, and offshore clearing vehicles. The aggregate figure associated with this adjustment approached $8 trillion when measured across currency swaps, maturity extensions, collateralized facilities, and reserve reallocations. The disclosure did not announce a single action, nor did it describe a unified program. It presented a set of administrative measures, each technically conventional, but collectively large enough to alter settlement dynamics across dollar-denominated markets. The measures included expanded bilateral currency swap lines with non-Western central banks, the rollover of long-dated dollar assets into shorter-term instruments, and a reclassification of certain foreign exchange reserves into liquidity buffers rather than investment holdings. Separately, Chinese state banks adjusted their use of offshore dollar funding markets, reducing exposure to overnight funding while increasing reliance on term facilities backed by sovereign collateral. None of these actions violated existing rules. None required emergency authorization. All were processed through established institutional channels. At the surface level, global markets continued to function normally. Treasury auctions cleared. Equity indices reflected routine volatility. Credit spreads adjusted marginally. Settlement systems remained operational. There was no announcement of crisis, no suspension of trading, and no visible shortage of dollars in retail or commercial banking. Administrative continuity remained intact, and that continuity itself became the dominant signal observed by participants. This apparent stability is not misleading. It is a feature of large monetary systems. Liquidity stress at scale does not present as sudden absence, but as gradual redistribution. What changes first is not availability, but access. What adjusts first is not price, but duration. These shifts do not announce themselves through headlines. They propagate through balance sheets. The central structural question emerges quietly. How does an $8 trillion administrative reconfiguration, executed within existing frameworks, interact with a global financial system whose primary reserve asset is simultaneously the primary instrument of public debt issuance? The question is not whether markets react. It is how internal constraints absorb pressure before external signals appear. This analysis does not assume that Chinese authorities intend to disrupt markets. It does not assume coordination aimed at destabilization. It does not infer motive. It examines compatibility. Specifically, whether the current configuration of Western financial markets can remain internally coherent under sustained, large-scale shifts in dollar liquidity management occurring outside their direct control. This report does not forecast prices, timing, or outcomes. It does not recommend allocation decisions. It reconstructs mechanisms already in operation and documents their interaction under stress conditions that are measurable, not speculative. Following the initial disclosure, additional operational details became observable through routine reporting. State-owned banks reduced participation in U.S. repurchase markets at specific maturities while maintaining exposure at others. Custodial holdings of U.S. Treasuries declined modestly, while derivative exposure linked to those holdings remained stable. Offshore dollar deposits held by Chinese institutions shifted geographically, moving from traditional Western clearing hubs toward regional centers with alternative settlement arrangements. These movements did not remove dollars from the system. They altered where dollars reside, how long they are committed, and under what conditions they are redeployed. In isolation, each adjustment falls within normal balance sheet management. In aggregate, they reach a scale where marginal changes influence systemic behavior. Western financial markets are structured around continuous refinancing. Government debt is not extinguished, it is rolled. Corporate credit is not settled, it is renewed. Liquidity is not stored, it circulates. This circulation assumes that large holders of dollar assets behave as passive reservoirs, absorbing issuance and releasing liquidity through predictable channels. When those holders modify their internal constraints, circulation patterns adjust accordingly. The analytical framing therefore shifts. The relevant issue is not the sale of assets, but the alteration of rollover behavior. Not the dumping of bonds, but the recalibration of maturity preference. Not capital flight, but collateral transformation. When a major participant shortens duration, the system compensates by extending leverage elsewhere. When a participant reduces participation in unsecured funding, secured markets absorb the difference. When collateral is reclassified, its velocity changes. None of these adjustments produce immediate failure. They increase dependency on precision. Precision in modern markets is maintained through assumptions of elasticity. That elasticity is not infinite. It is bounded by regulatory capital requirements, by clearing capacity, by risk-weighting frameworks, and by political tolerance for balance sheet expansion. The $8 trillion figure matters not because it represents a weapon, but because it approaches the threshold where marginal adjustments exhaust buffers. At that scale, the system no longer absorbs changes invisibly. It reallocates stress. Historical precedent offers context. Previous periods of large reserve reconfiguration did not trigger collapse. They triggered adaptation. The difference today lies in starting conditions. Debt levels are higher. Monetary tools are more constrained. Regulatory frameworks are tighter. And cross-border trust is thinner. This does not imply inevitability of disruption. It implies reduced slack. Reduced slack increases sensitivity to coordination failures, timing mismatches, and administrative delays. Markets can function under stress as long as sequencing holds. When sequencing fails, volatility increases without warning. The continuation of this analysis will examine how similar dynamics unfolded in prior cycles, how structural imbalances accumulated gradually, and how systems maintained outward stability while internal constraints narrowed. For now, the observable fact remains limited and precise. A large monetary authority adjusted its dollar-related balance sheet structure within existing rules. The scale of that adjustment exceeds historical norms. Western markets continue to operate normally. The compatibility between these two conditions is the subject of the sections that follow. In order to understand why a balance sheet adjustment of this magnitude carries systemic relevance, it is necessary to situate the present configuration within a longer historical pattern. Large monetary systems do not fail at moments of decision. They evolve through cycles of accumulation, accommodation, and constraint. Each cycle resolves temporarily, not structurally. The current configuration is the result of multiple such cycles layered on top of one another. Since the end of the Bretton Woods system, the US dollar has functioned simultaneously as national currency, reserve asset, settlement medium, and collateral base. This multifunctionality has no historical parallel at comparable scale. It created efficiency, but it also fused roles that are normally separated. As long as global trade expanded faster than debt issuance, this fusion remained manageable. As long as confidence substituted for convertibility, stability persisted. China's integration into this system occurred during a phase of rapid globalization. Export surpluses were recycled into dollar assets. Reserve accumulation was framed as stability-oriented behavior. Western markets interpreted these inflows as confirmation of system legitimacy rather than as structural dependence. Over time, reserve accumulation ceased to be marginal support and became a core stabilizing function. What is often overlooked is that reserve holders do not merely store assets. They intermediate them. Their balance sheets absorb duration risk, currency risk, and liquidity mismatch on behalf of the system. When reserve accumulation slows or reverses, the system must internalize those risks elsewhere. The global financial crisis marked a turning point. Central banks expanded balance sheets dramatically to stabilize markets. This intervention preserved continuity but altered structure. Private risk was replaced with public balance sheet capacity. Liquidity became abundant, but its distribution became increasingly policy dependent. Markets adapted to a new normal of continuous support. Subsequent cycles reinforced this dependence. Each episode of stress was resolved through larger interventions, longer durations, and broader collateral acceptance. The system did not deleverage. It relayered. Debt levels increased, while interest rate sensitivity declined. This configuration remained functional as long as external holders continued to behave predictably. China's internal financial evolution followed a different path. Domestic credit expansion, demographic transition, and capital account management imposed constraints distinct from those faced by Western economies. Over time, the cost of holding large quantities of low-yielding dollar assets increased relative to domestic stabilization needs. This created a tension between external stability and internal balance. The recent adjustment reflects this tension. It does not represent disengagement from the dollar system. It represents optimization under constraint. Duration was shortened. Liquidity was prioritized. Optionality was preserved. These are rational balance sheet responses in an environment where future conditions are uncertain and buffers are finite. The structural implication is subtle but consequential. When a major holder prioritizes liquidity over yield, the system loses a source of passive absorption. Issuance must still clear. Refinancing must still occur. The difference is that absorption shifts toward actors with higher sensitivity to price, leverage, and regulation. This shift introduces a staging process. In the early stage, markets adapt smoothly. Dealers increase balance sheet usage. Central banks adjust facilities. Regulatory thresholds are approached but not breached. Volatility remains contained. This stage can persist for extended periods, creating the impression of resolution. As adjustments accumulate, the second stage emerges. Marginal liquidity becomes conditional. Certain maturities clear easily while others require incentives. Repo markets become segmented. Collateral premiums diverge. These signals remain technical and are often interpreted as noise rather than structure. The third stage involves constraint convergence. Multiple subsystems reach their respective limits simultaneously. Dealer balance sheets approach regulatory ceilings. Central bank facilities face political scrutiny. Foreign holders reduce flexibility further. At this stage, the system remains operational, but redundancy is minimal. The importance of scale becomes evident here. An $8 trillion reconfiguration does not act through a single channel. It acts through cumulative pressure across many channels. Each channel absorbs a fraction of the adjustment. The total effect is distributed, making attribution difficult and response fragmented. This distributed pressure interacts with arithmetic realities. Public debt must be refinanced continuously. Refinancing requires buyers willing to hold duration. If those buyers shorten duration, refinancing frequency increases. Increased frequency amplifies sensitivity to funding conditions. Sensitivity increases reliance on policy support. Mathematically, this creates a narrowing corridor. The system can function as long as refinancing costs remain below growth capacity, and political tolerance for intervention remains intact. The margin between these variables has narrowed over time. That narrowing is observable in debt-to-output ratios, fiscal projections, and central bank balance sheets. This is not a forecast of failure. It is a description of reduced degrees of freedom. Reduced degrees of freedom mean that adjustments elsewhere carry larger consequences. Policy errors become more costly. Coordination delays become more impactful. External adjustments, even neutral ones, propagate more strongly. The Chinese measures did not create this configuration. They intersected with it. They revealed how dependent the system has become on the passive behavior of large holders. When that passivity is replaced with active liquidity management, the system must adapt. The adaptation process is ongoing. It is administrative, technical, and largely invisible. It does not require crisis to matter. It operates through balance sheets, not headlines. The question is not whether the system responds, but whether its response space remains sufficient. The final phase of this analysis will examine how these constraints interact mathematically, how timelines emerge without prediction, and how risks and counterpoints should be evaluated within a non-sensational framework. As the system advances beyond its initial adaptive stages, the interaction between duration, compression, and refinancing necessity becomes more explicit. When large holders reduce maturity exposure, the volume of instruments requiring rollover within shorter intervals increases. This does not imply insolvency. It implies acceleration. Acceleration increases the frequency at which markets must clear under prevailing conditions rather than averaged ones. In this phase, convergence matters more than magnitude. Individual constraints that are manageable in isolation begin to overlap. Fiscal authorities must issue within political limits. Central banks must provide liquidity within mandate boundaries. Dealers must intermediate within regulatory capital frameworks. Foreign holders must manage reserves within domestic stability requirements. None of these limits are absolute. Together, they define a finite operating space. The advanced stage of the structural model is characterized by synchronization risk. Funding markets, collateral markets, and sovereign issuance schedules become increasingly interdependent. Small timing mismatches produce disproportionate effects. Liquidity that exists in aggregate becomes temporarily unavailable where and when it is needed. This condition does not halt markets. It introduces fragility without collapse. Mathematically, the system approaches a state where flow consistency matters more than stock adequacy. Total liquidity can remain ample, while usable liquidity becomes conditional. This distinction is critical. Stock measures capture balance sheet size. Flow measures capture functional capacity. Stress emerges when flows cannot be aligned despite sufficient stocks. At this stage, central bank facilities become structural rather than exceptional. Their role shifts from backstop to conduit. This shift is not announced. It is inferred from usage patterns, maturity extensions, and collateral eligibility expansions. Political oversight intensifies not because of crisis, but because permanence invites scrutiny. The arithmetic of scarcity does not imply absence. It implies prioritization. When resources are finite, allocation becomes selective. Some markets clear more easily than others. Some maturities attract demand. Others require accommodation. These patterns are often interpreted as technical distortions. Structurally, they reflect boundary conditions. The closing logic follows directly. A system built on continuous rollover requires stable expectations about participation. When major participants adopt flexibility over commitment, the system compensates by increasing dependence on institutions with constrained mandates. This increases sensitivity to non-economic factors, such as regulation, politics, and public tolerance. The future timeline under such conditions does not unfold through singular events. It progresses through monitoring. Adjustments are incremental. Responses are iterative. Stability is maintained through continuous intervention rather than discrete resolution. This trajectory can persist for extended periods. Multiple scenarios coexist within this framework. In one, coordination remains sufficient and adaptation continues quietly. In another, sequencing errors amplify volatility temporarily before being absorbed. In all scenarios, the system remains operational. The distinction lies in cost distribution, not survival. Risks must therefore be framed precisely. The primary risk is not sudden market failure, it is gradual reduction in optionality. As buffers are utilized, recovery from shocks becomes slower. Policy responses become more targeted and less universal. Market participants adjust behavior accordingly. Counterpoints are essential. Large systems have demonstrated resilience under comparable pressures. Innovation in settlement, collateral management, and cross-border coordination can expand capacity. Behavioral adaptation often precedes structural reform. These factors mitigate deterministic conclusions. However, mitigation does not reverse arithmetic, it reallocates burden. Structural constraints remain unless underlying balances change. The interaction between public debt levels, reserve management, and global liquidity cannot be resolved through signaling alone. This analysis does not conclude with a call to action. It concludes with a requirement for observation. The mechanisms described operate continuously, not episodically. Their effects are cumulative, not dramatic. Understanding them requires attention to balance sheets, not narratives. The Chinese balance sheet adjustment did not introduce a new force into the system. It interacted with existing ones. Its scale made that interaction visible. Western markets did not break as a result. They adjusted, as they are designed to do. The question that remains is not whether adjustment continues, but how much structural margin remains available before further adaptation requires explicit redefinition of roles, mandates, or expectations. This report documents a system in motion, constrained but functional, stable but sensitive. Monitoring rather than prediction remains the appropriate posture. The process continues.